the intermediate trend of the S&P has rolled back over to rejoin its long-term trend, but the annual momentum trend of T-bonds, by measuring it on an annual momentum basis, not price, is negative. So the rally we're getting in price now is counter to the long-term trend. Anyway, but ultimately, when this all filters out, I think gold will be the leading market to be in, gold and silver. How come gold keeps going back to 2000 plus? What does it know? Who's buying it? Yeah, it seems to be capped, but you look at the history of gold, there's never been a pattern where gold's gone back to the high, back to the high, back to the high, back to the high. It's telling you it's going through. And we think gold is going to launch shortly.
Gold prices in the early Asian trading session on Friday continued their rally, propelled by a decline in US Treasury bond yields. This surge in the precious metals value was buoyed by diminishing yields, igniting a strong resurgence in stock markets and lifting US government bonds from their 16-year lows. Yet amidst this bullish trend, confident investors are growing concerned about the potential consequences of prolonged yield drops. There's a prevailing worry that an extended period of declining yields might encourage the Federal Reserve to persist with a hawkish stance, potentially impacting asset prices in the long term. Gold prices rose to their highest levels in more than 2 weeks on Tuesday, aided by a weaker US dollar and lower Treasury yields as investors look forward to minutes from the Federal Reserve's latest meeting for Qs on its interest rate outlook. Edward Meir, a metals analyst at Marex, noted, "The dollar and US bond yields continue to decrease. Central bank demand remains strong. All these factors are bullish for gold. The market is reconsidering the recent drop." Michael Oliver, founder of Momentum Structural Analysis, observes that while the S&P's intermediate trend realigned with its long-term trend, the annual momentum trend for T-bonds, measured every year rather than price, is negative. Despite the conflicting current price rally in T-bonds and their long-term trend, Michael foresees gold emerging as the dominant market. He ponders the sustained surge in gold prices, questioning the underlying reasons for the recurrent spikes beyond $2,000. Michael articulates the Federal Reserve's potential response to the bond market upheaval. He suggests that the Fed's possible inability to raise rates further due to a bond market crash might prompt the need to defend government debt. This defense could involve printing money to purchase bonds, a historical move that tends to channel funds into precious metals like gold. This analysis ties into the cyclical pattern where central banks printing money to rescue struggling asset categories ultimately benefits gold. These monetary fundamentals bolster the theory of an imminent significant increase in gold's value. We will present clips from Michael Oliver's interview with WT Finance. But before we do, if you want more videos like this, please hit the subscribe button and turn on the notification bell for more updates. Thank you and enjoy the video.
This past summer, we put out a report saying the T-bonds were going to have a nuke event, downside nuclear event, and they crashed. T-bonds effectively, if you look at a price chart of T-bonds, you'd think you're looking at some commodity, limit down almost, a huge straight down decline. And what's so funny is that it wasn't a broad bond market event. It was US government bonds. We started to look like Japanese bonds during the summer and into the low last month. But you look at things like muni bonds, they only marginally went down and took out last year's low, where the T-bonds crashed through those lows. And if you look at high yield corporate debt, which doesn't look good, but it didn't take out those October lows of last year. So the T-bonds in and of themselves were in a crash mode. Well, what does this mean? We thought it would lead to a V bottom, where you would get a major counter trend rally in bonds. And I think we're in the process of seeing that now. It's not going to last, but that market was vastly oversold. But the fact that the T-bond market did what it did, way beyond what the Fed would like to have seen. They like to play this incremental game on the shorter end of the market, which, by the way, is no issue. It's over. They're not raising rates again, okay? Why? Because their T-bond market crashed. They cannot afford to not defend government debt. And the T-bond market put them in a position where, even though they won't admit it publicly because that would admit fear, they have to, at whatever cost, defend government debt market. However much money they have to print to buy those bonds, they're going to have to do it. Well, who's the beneficiary of this? Gold. Every time the central bank goes from a boom to a bust back to a boom cycle, where they deem that they have to print money to save a given asset category that they save, like the stock market or the bond market, the money flow goes ultimately into monetary metals. So we think the prime beneficiary of this process, this transition of the Fed back to monetary easing, is gold. And that's probably the reason. If you look at take a monthly bar chart of gold, go back to the 2015 low, for example, when it was $1,000, $1,050. Okay. It doubled by 2020, had a sharp drop, came back up in 2022, had another real sharp drop. I say sharp, I mean 20%. And then you come back up here early this year again to well over 2,000. And then you, for the last, through last month, you had a pullback that took you down into the 1800s. And now you go back to 2,000 again recently. What's going on here? How come gold keeps going back to 2,000 plus? What does it know? Who's buying it? Yeah, it seems to be capped, but you look at the history of gold, there's never been a pattern where gold's gone back to the high, back to the high, back to the high, back to the high. It's telling you it's going through. And we think gold is going to launch shortly. Why? Because of the fundamentals I just described, monetary fundamentals.
The recent surge in gold prices has been remarkable, witnessing an impressive jump of nearly 18% just this month. This surge appears to be linked to a shift in the behavior of institutional investors who are increasingly moving away from US Treasury bonds and redirecting their investments towards gold markets as a secure haven. Interestingly, since last October's low point, T-bonds and gold have seen substantial rallies, moving somewhat in tandem. However, a notable divergence emerged in March when T-bonds began a downward trajectory while gold experienced a slower decline. Notably, gold didn't return to its October lows, hovering in the lower 1800s, creating a subtle shift from its previously synchronized movement with T-bonds. Michael highlights a recent resurgence in T-bonds, indicating a renewed alignment with the movement of gold. While this synchronicity might not persist indefinitely, indications indicate a potential rally in T-bonds looming on the horizon. He suggests its recent retreat to around 1826 might signify a temporary low point. He anticipates a swift rebound, propelling gold prices above the $2,000 mark. Moreover, there's a possibility of a more substantial upward trend shortly. Let's get back to the interview.
The synchronicity between T-bonds and gold has been pretty good. Now, this isn't true most of the time. Most of the time, bonds will go opposite price-wise, opposite the price of gold. But since last October's low, T-bonds had a good rally, very substantial rally. And so did gold. Gold had a major rally from the 1600s back over 2000. And then early this year, if you look at T-bonds, like back in March, and look at gold back in March, they crested. And T-bonds went down slowly. Gold went down very slowly. But T-bonds crashed. And gold didn't crash and go back to its October lows, which would have been in the 1600s. Instead, it went to the lower 1800s. They got slightly out of sync at that point because gold exploded starting in early October. And T-bonds, we thought, would probably follow gold, but they were lagged this time by about 3 weeks. And all of a sudden, the T-bonds are now starting to explode like a V bottom in price. So they're getting back in sync with gold. And I don't think this synchronization will last, by the way. The T-bonds ultimately are a bear, but I think you're going to get a nice rally here. And I think probably one of the causes is, without stating it, the Treasury and the Fed's got to be supporting that market in the dark or whatever. And there's a lot of big asset managers, too, that realize that the normal alternative to the stock market, the 60-40 portfolio mix, stocks and bonds. Suddenly, last year, of course, bonds were terrible. They were worse than the stock market. So that balanced portfolio was very dangerous. But suddenly now T-bonds look like they could actually go up. So the guys who are buying stocks right now thinking, oh boy, rates are going to go down, which they are on the long end because the bonds are rallying. Okay. It's not going to last. And even if the Fed does shift policy, it's not good for you guys. They don't know that. They haven't gone back and looked at history, 2000 top, 2007 top. So anyway, I think the stock market rally is delusional, and I strongly suspect that it's going to roll over, and by year end and early next year, you'll see the pain start to come to the stock market in ways that people finally say, oh gosh, we got fooled. And meanwhile, the gold pullback, we think that low we made last month at 1826, within 16 trading days, gold was back over 2,000. And it wouldn't shock me to get back over 2,000 again pretty quickly here and then probably launch. But I think the main driving factor here is, again, the central banks of the world have to revert to what they do best, and that's print.
Gold prices surged due to falling US Treasury bond yields, igniting a bullish trend. Speculation about the Federal Reserve's response to bond market turbulence suggests funds might flow into gold, historically favored in such scenarios. These trends suggest a potential ongoing rise in gold's value soon. What are your thoughts on the future price movements of gold? Share your observations in the comments section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.